morning, Kayode. Good to see you again.
Yes, sir.
How's everything now?
Life is good. Life is exciting.
Nice.
And the price of fuel is coming down.
Hallelujah, right?
Amen, my brother. Amen.
I'm telling you, man. So, today, backed by popular demand, as always, right, we have Idika Aja. Idika, welcome again.
Thank you, and Kayode, good morning.
Good morning. So our audience, they're always like, where is he? Where is Idika? We need Idika back. We need Idika back. So, we're speaking today on how much is your 1 million naira investment worth in Forex versus equity versus bonds. So he wants to explain to us, the difference in investment opportunities,
equity,
and bonds. Yeah. So welcome again, Idika, and we're all looking to learn today.
Thank you very much.
Yeah.
It's good, and Kayode.
Yeah.
It's good to be here.
Yes.
Yes, actually, bonds, equities, and Forex are different asset classes, which you can invest.
Okay, go on.
Which you can invest.
Mm-hmm.
You understand? And we are looking at an investment of 1 million, right?
Yes, that's the cap. 1 million.
That's the cap, 1 million. Now, we are looking at the time frame is actually, we are taking 2024.
Yes,
okay,
exactly.
Fine.
Yes,
now, first of all, let's start with bond.
Yes.
And if you are going by 10-year...
wait, sorry, before you go further, right? Just so for people that, don't necessarily... understand finance. Understand? Can you just briefly define what bonds are, equities, and Forex? Just briefly.
Okay. Bonds are debt instruments.
Okay.
Issued by the federal government.
Okay.
Or corporate organization.
Mm-hmm.
It's just a means of federal government trying to borrow money from individuals, from corporate organizations.
Okay.
They issue the debt instrument, and people now subscribe and buy.
Okay.
So it's just like, okay, I want to borrow money from you, just like corporate organizations that wants to borrow money too.
Yeah.
So it's just in just a simple thing, just like a loan.
A loan from the government.
Federal government wants to borrow money, so that's what it means.
Okay.
Now.
Go on.
Equity on that side, stock, which is normally we call stock, is whereby you buy into a company by buying their shares, so you become an owner and a shareholder of the company. Okay. So that is what it means. Then the other one, Forex, is when you trade in between, find out you trade between currencies. Yeah. The exchange rate, either USD Naira or USD Japan and so on. That is basically what it means.
Okay. Thank you very much. Thank you so much for explaining. So then let's go into it. Let's start with investing in bonds.
Okay.
So in your article you mentioned as of December last year. Let me quote you. As of December last year, the 10-year federal government of Nigeria bond had an average yield of 21.6%. So could you explain what this means for an investor, and who placed 1 million naira investment at the beginning of January?
Okay, that is you have to understand that is just an average yield.
Yeah.
It's different from what we call, when you talk of investment in bonds, we have what we call the coupon rate, we have what we call the yield. Normally what we call the yield to maturity, YTM.
Okay.
Now, the one he's mentioning is just average yield, what the market yield is at the end of that year. Now, basically, just in a very simple, it means that for investment of 1 million naira, you'll be getting around 216,000 naira.
Okay. So
if you hold it till maturity, that is
December at the end of the year.
December. Now, why that thing is important, because let me just explain. Because if you don't hold it to maturity, the yield fluctuates. Okay. You understand? So if you now sell maybe before the end of the tenure, before maturity, you can get less, you can get more.
Okay. Why? Because the interest rates.
Yes, because of the interest rate.
Okay.
You know, in bonds and interest, bond price and interest rate and they have
They are linked together.
inverse relationship.
Okay.
So if the interest rate is high, you understand, the bond prices will come down.
And vice versa. Okay.
So what normally matters, in this case, we assume that is the coupon rate. We assume that is the coupon rate. That is 21.6% issued. Now, at the end of the year, you get 216%. That's basically what it means.
Okay.
And normally, coupon rate is paid biannually. That's every 6 months. So in that case, maybe for the first 6 months, you get 108,000. Then another 108,000. Now, where the problem comes, or where you have, especially when there is a variation in the total return, is at times when you get the 108,000 naira for the first 6 months, at least you have to look for where to put it. Is it not so?
Yes.
So that is where the reinvestment risk comes in.
Okay.
So that 108,000 naira given to pay you for the first 6 months. Now, if the interest rate comes down, that means you are reinvesting at a lower rate. That means that will not affect your total return.
At all.
You understand? Then if the interest rate goes up, you have to invest and earn more. And that will now equally affect the total return of the whole investment.
Okay.
So you now get the difference. If you hold it, I mean if you hold it, if you don't sell, normally when they issue, you can decide maybe after 3 months I want to sell. That's when you get to the secondary market and sell. And the secondary market is determined, what you say determines on the interest rates, prevailing interest rate.
Okay.
And that's what we call the yield. Okay. So on average at the end of the year, the yield was that figure, 21.6%.
Okay, that's good. So definitely bonds is a viable option to actually invest.
Yes, it is. It has a stable income.
Because you are dealing with the government, your money is guaranteed, right?
Yes. That is another thing. Another thing you have to understand with that yields I mentioned there is equally a guide to you.
Okay.
Now, what it's telling you is this. Now, assuming like Ogiva Nigeria Limited issues a bond, which is now a corporate bond.
Yes.
What is telling you that Ogiva's coupon rate should not be less than that 21.6%.
Period.
Yeah. Because if I'm buying from Ogiva Nigeria Limited, its corporate bond, it should give me a coupon rate that is higher than that of federal government because you can default.
Yes. You can't default.
You can't default. So it is just a benchmark. And it really goes to even people who are doing business. Because if any asset is giving you return less than that 21.6%, it doesn't make sense.
Yeah,
because you can equally go and put your money in federal government bank and go and sleep instead of carrying papers or carrying
pushing them.
At the end of the year, your return is not even up to that federal government return yield. So it doesn't make sense. So it's equally a guide to investors, even traders. So it's not just enough for you to be running around, okay, I'm doing trading, and at the end of what is the return? What is he giving you?
Yeah.
So if whatever you do is not giving you return more than this rate, close that thing down and move your investment to bond. I buy from federal government bond that will give you that return. I think the coupon rate is 15%, 10%, 16%. Then you are sure of getting that.
Yeah,
that is just it.
Fair enough. Let's move into equities because I just hope we have enough time. So the question applies. The same question applies with equity. We know how the stock market, have volatilities and all that, but can you apply the same, question, right? Where investment, for someone that invested $1 million in equities at the beginning of January, you understand?
What it will
give you now? Okay,
now let's take it. Let's look at it from this angle. Now, normally the equities, Nigerian stock market is measured by the all-share index.
Yeah.
Yes. In 2024, I think it's about 37.65.
Yeah.
That is the benchmark. Now, that means, assuming you now use that, your investment will give you, I think, 365,000 naira. So you will get at the end of the year 1,365,000 naira. That is what it means. But you don't just invest in the all share index. It's just a mirror. Now, if you now look at individual stocks, if you invest in individual stocks, you might likely get more than that. For instance, yes, in 2024, we have Julie PLC that returned about 1,645. So that 1 million will give you close to 17 million.
Yes.
That is the meaning. It will give you close to 17 million. Now, okay, leave Julie PLC. If you use Uando, I think the one you know very well.
Yeah.
Uando has returned about 529%. That will give you over 6 million. That 1 million will give you over 6 million. The same thing with Transcorp. Transcorp will give you about 4.something million.
So definitely those what do you call them? Individual bonds. Equities.
Yes.
Is a very good space to play, to dabble in, right? In investment wise.
Sure. But the most important thing, you have to look at it very well, study it very well, monitor it very well, and that requires your active participation.
Okay.
If you can't do it, like I said at that time, you get your financial advisor to help you. But you can see the thing. But if you if you are using the all share index, that means that is what it will give you. Even if you look at the compound annual rate of all share index for the past 5 years, I think we have about 39.96%. So it is still good.
It's still good. That's actually
good. For 5 years, and that's what it has given you. What you have. Okay. So it's good. But even if you spread it, you said, okay, you invest maybe about 10 stocks. You have your average return. Calculate them, weight them, and have your average return. Maybe you invested in Transcorp, you invested in Uando, invested in Seplat. Each of them gives very
so if you have
return, then you
large portfolio,
get the average. You can then see what it will give you. But give and take, it will give you more than bonds.
Definitely.
But the only thing
you have to study. You have to do more work.
You have to do more work. Unlike when you invest in bonds, just invest, go and sleep. Wait, don't sell before maturity.
To the end of the year, and
at the end of the year, collect back your money. Then every 6 months they will pay you your coupon rate. So at the end of the year, you collect back your 1 million naira and collect whatever coupon that is paid to you.
Yes.
So you don't need to be all that active. It's more or less like a passive investment.
So I guess definitely even in that category, you probably have to invest a whole lot more. That's going back to bonds, right?
Yeah.
As against 1 million, the 1 million naira investment, you probably need to have a larger investment capital.
If you want, but mainly for if you are maybe a bit getting down, maybe old,
don't really have the energy.
You don't have energy again, and you have trained, you have done everything. Maybe train your children, you just want more
also like take care of yourself.
Then not like for instance Silas that still young, he can go for equity, he can go for Forex.
Silas will not allow anybody here again.
So basically that is it.
Okay, that's good. So we'll move on to Forex now. I mean, we know Forex was crazy, right? Forex is still crazy right now, So a lot of people feel Forex is just buying the currency and just holding, right? And I think definitely it's a lot more than that. So for someone that invested 1 million, in Forex last year, let's go there as well. Okay,
now let's just use the simple one. What is the exchange rate beginning of the year?
Yeah.
In 2024, I think it was.
Sorry. Go on.
It was about, let's use 899 to $1. Then at the end of the year, you have. I think 1,539. If you check the percentage growth, you have about 78% thereabout. So that will now give you 78%. So 1 million will give you 1,780,000 naira. So you see, you are making 780,000 naira out of it. You understand? Now, which is even higher than 216,000, higher than the all-share index average of, let's say, 37.7, that's 375. You can see that Forex gives more return. But it is very, very volatile.
It was. It really was.
You can wipe out your investment.
So that's the risk there.
So for those investors who are still young, who are risk tolerant, they can take risks, and you have time because it requires energy and time.
Yeah.
It requires monitoring. Has a higher monitoring rate than equity and bonds. So you have to really monitor it. And even at that, it requires that you can exit, come in, go out, come in, go out, unlike bond.
Yes. Most is not necessarily fixed.
No, it's not necessarily fixed. I just gave you an example.
Yeah, exactly.
So when those are even the platforms that trade on Forex, you can see you can buy today and sell, dispose, go on. But it's very, very volatile and it's very, very risky.
Okay, so definitely, Forex is the tastiest, but
yes,
definitely
for
comes
quick
with a lot
money,
of-
for quick money, you want to make quick money, you want to cash in, cash out. Forex is it, but it's very risky.
Okay, so speaking of risk, right? So I mean, we've established the investments in 3 different categories. So we want to do a little more detailed comparison, right? So I actually have some questions in regards to that. So when we compare these 3 asset classes, so which one has the highest risk and why?
Okay, bond has the lowest risk. Bond has the lowest risk because one, you can easily know what is coming to you. Like the one example we use, 21.6%.
21.6%. Hold on.
Every 6 months, if you hold it, you get 108,000. Now, where the problem comes is that if you want to reinvest that 108,000, if the interest rate is down, you get less. If the interest rate is up, prevalent interest rate is up, you get more. But this is what is coming to you. Even if you don't want to reinvest, you get that. At the end of the tenure, you get back your 1 million naira. So it's none. Now, in the case of equity, I think even in 2024, I don't want to mention the company.
Yeah.
Assuming the company, if you are invested in a particular company that lost over 60%, you can see you are losing about 600,000
yes.
of
Definitely.
your 1 million naira. You understand? So the risk is there.
Yeah.
So the possibility of you losing the whole 1 million naira is there.
Is there. Yeah.
Then the same thing with Forex. Forex is more volatile, and if you don't even monitor the exchange you are trading on, it will give you more problem. And it's something that even if you invest now, especially you watch the margin, the leverage the platform is giving you, because some of them give you leverage that give you money to trade. So that increases your risk too. So it's more volatile and more risky than bond and equity.
Yeah, definitely. So if I need cash, if I solidly need cash, which of these investments gives me the access to be able to pull out my cash?
It's Forex.
Forex still.
Yeah, Forex will give you more opportunity to get cash easily.
Yeah.
Because bonds, even if you want to dispose your investment, you might not get buyer easily. That your total return might come down. It's possible. Then the same thing with equities too. Equities, which I didn't mention, there is what we call the cost of transaction. When you are dealing in equities, I think according to NGX rule, everything put together, because there are some they pay to Securities and Exchange Commission, you pay one to NGX. But on the buy side, I think the total transaction fee should be about 1.43%.
Okay.
So that's what they charge you. So if you are investing, you are buying 1 million worth of shares. On the buy side, the total transaction fee is about 1.43%. Now, if you are selling 2, I think the transaction fee should be 1.7 thereabout. So you can see you spend money, the transaction fee. So, but on FX trading, it depends on the platform. So it's too technical. you have to first of all sit down
To
and study
learn
it,
it,
go for
yeah.
training, study it very well. Otherwise, you see your investment just
Go all over to be,
going
yeah,
on. So
definitely. You need to even have that much
you need to
control.
you must have that control. You must train, study it, go for training. You know,
Yeah.
like a bond, you just open an account, buy,
And that's it.
get your primary market dealers, subscribe, then send money to them. They'll buy for you. You know, last time I mentioned that you must have a trading account. If you are
yes.
buying primarily from if you are buying from the primary market. Because that will not give you, when you open that account, you have your CS account, Central Security Clearing System number, which is unique, just like your BVN. So that is where the now warehouse your investment. So once you've done that, you can go and sleep if it is bond. And then if it is equity too, you can get your financial advisor to handle it for you. But in the case of Forex, yes, some of them advise that they can trade for you.
Yeah.
But it's very risky.
Yes, it is.
But for you to be able to deal with Forex, you have to be knowledgeable.
Yeah, it's not somewhere. It's not even because the consequences can be very bad.
Yeah. You have to.
Yeah. So moving on. So how does inflation and foreign currency fluctuations actually affect all three of them? Do you understand? That's bond yields, forex trading, and equity.
Okay, that's what we call the microeconomic variable, the micro variables. Now you have the interest rate, you have the inflation, then you have the exchange rate. Now, basically, in the case of let's use bond, I've mentioned it, especially the interest rate and inflation rate. They affect bond.
Okay.
Pricing of bond. Now, if you buy bonds, normally they issue that they have what we call a coupon rate.
Yeah.
That is what
you
get.
mentioned that.
Yeah, that's what you get. If it is every 6 months, if it is 15%, you get 15% of 1 million naira every 6 months.
Okay.
Do you understand? Now, that means if you hold it to maturity, the inflation rate, the inflation will affect it. But let me talk about the interest rate. Interest rate will not affect it because you get that.
Your coupon rate.
Your coupon rate is there.
Yes.
Now, where you have problem is that if you want to sell before maturity, that's where the interest rate issue comes in.
Okay.
Because if you want to sell, now you now sell at the prevalent interest rate. That's what we call the yield, the market yield, which can be lower or higher. Now, if the interest rate is high,
you can trade.
The yield will be high, but the price of the bond will be lower.
Will drop.
Yes. Let me explain this. Now, why it is like this. Now, the price of a bond is the present value of the cash flow. Okay. I don't want to sound too technical.
Yeah.
But the price of the bond is the present value. That means you have to discount it back to the present value. Like 1 million naira we are saying now, all the cash flows you are going to earn for 10 years, you have to discount it back to the present value. And you use the yield to discount it at that prevalent time, at a particular time. So that will now affect the overall price of the bond.
Yeah.
So you see how the interest rate affect the bond. Then in terms of inflation rate, no matter which is the baba, if the inflation at the end of the whole thing, if the inflation rate is higher than the coupon rate or even the yield, that means the real return is negative.
Yes.
That means you are equally losing money. Unless you are dealing with what we call inflation index bond, where it is tied to inflation, then whatever inflation rate is, you now get the value and multiply it by the coupon rate to go. So that one will not be affected by inflation.
Yeah.
Now, the same thing on equities. Normally, when the interest rate is high, people tend to move to fixed income assets.
Yes.
You can see what is happening now. Now, the 21.6% we mentioned last year, because interest rate is about stabilizing, or people are saying that as at February, it has come down to 18.8.
18.8.
Yeah, 18.8. So that is where it is now. You can see the interest rate has dropped.
Yes.
And that will affect the price of the bond.
Mr. Idika, I've had too much and we have run out of time.
Yes, I know.
Unfortunately.
It's
I really have a lot of questions, but I'll find a way, to definitely
Don't
get you in the
worry.
studio.
We have many Wednesdays this year.
Yeah, many Wednesdays this year.
There's one tomorrow. Next week, that's so.
I just always love to learn, so it was really good,
And
having you.
just to chime in there, to show you how impactful it is, someone just asked for Ogiva's number, and I told them that I felt so insulted. I said, you can't come to me for financial advice. that is so demeaning.
No,
So all I can do is talk on radio and talk politics.
No.
You didn't say, okay, please give me your number.
No, we'll apply. We'll go back to those conversations. Definitely.
So I've told them, and I definitely will reach out to you.
Okay,
He has
then.
a number that wants to.
No problem. All right, then. No problem, man. We can always talk.
So let's bring it home.
All right, then. So, thank you everyone for being on the show today. You can always catch up with us on our YouTube channel. Catch up on our YouTube channel and also on Spotify. And don't forget to follow us on all social media platforms at Nairametrics. Bye.